Hello and welcome to True Potential's review of the week in markets. Today we'll look back at some of the key events over the past 5 days and how they have influenced asset markets. I'm Jeff Casson and I'm joined by Paul Durrans, one of the investment directors here at True Potential. Just to maybe set the scene a little bit, a fortnight ago we discussed the real focus that the market had on interest rate decisions from the Fed and from the Bank of England. This week brought us some more data that was very influential in that interest rate debate, that being the inflation readings from the US and also the UK. And we'll go into those in a bit more detail now. So Paul, from your perspective, a really important week really from data for markets, and up first was the US CPI report. And did that bring a surprise, or did it bring the evidence that people were looking for of that disinflationary trend?
Yeah, so exactly right. Coming into the week, US inflation, most important for global investors, it surprised disappointingly in terms of inflation came in above what was expected, coming in at 3.1%. Headline inflation, that's year on year, so above the 2.9% expected. We saw core inflation, so removing food and energy prices, more volatile. That was unchanged at 3.9%. So challenging the disinflation narrative, challenging the expectations of when interest rates could be cut. Market coming into the week expecting perhaps May. That's getting pushed out a little bit into June.
And
now.
Within the inflation data, was there any component parts of that led to that surprise to the negative side? What were they?
Yep, so the key one was the shelter costs component. So that sits within the core services section, and what the Federal Reserve, the US Central Bank and the market's been expecting is that the shelter component, which has been very elevated, somewhat sticky, would start to come down, and in their models they are projecting it to start to fall. We actually got an increase of 0.6% month on month, so going against that trend, and again a challenge for markets.
And I suppose that's been one of the points that as a team we've been discussing and we've been referencing, just in terms of the volatility that these data points are certainly bringing into asset markets. And when we look at how the Treasury market, for example, reacted in the equity market with that inflation reading in the US, it was very noticeable earlier in the week.
Exactly, yeah, and I suppose we saw bond yields, US Treasury yields sell off a little bit. Actually, the US equity markets handled it relatively well, but I suppose speaking to that volatility, you typically get an elevated level of volatility in inflation in January, known as the January effect, because businesses at the start of the year reset their prices for the year ahead.
And there was a degree of some people I read just talking about the weather patterns and things like that. They're just some of these seasonal effects that work their way through there. Maybe then the other key inflation data point was here in the UK, and again there was probably a concern that it was going to disappoint in the upside, but that, in contrast probably to the US, wasn't what we got.
No, the UK has lagged the US inflation cycle, but surprised to the downside, which was pleasing for the Bank of England, coming in at 4% unchanged from the previous month. Expectations were for 4.1. So a positive for UK government bond yields, which rallied on the day. So it still puts the Bank of England in a somewhat challenging position still, because we still have inflation well above the 2% target, and we'll come on to wage data is strong as well.
And I suppose that the strength of the wage data was the bit that's not removing itself, if you will, from the UK data. It's there as a challenge to the interest rate reduction thesis, if you will, that inflation, just as you rightly say, is potentially a little bit stickier as a result.
Exactly. So, we had start of the week as well, labour market data, unemployment remaining at 3.8%, or slightly down at 3.8%. But the wage data, whilst it's easing, coming down, it's not coming down as fast as we expected. So if I look at the numbers, average weekly earnings came in at, excluding bonuses, came in at 6.2%. So still pretty strong, but I suppose pleasing is that it's above the inflation rate.
Yeah.
So people getting real wage growth. That's positive because they can consume more.
And maybe just linking to that, can consume more real wage growth. When we look at the data that we got this morning on the UK, I think you and I, when we come in and we saw it, we were a bit surprised at the underlying strength of retail activity in January.
Absolutely. I suppose if we just take this month of January, retail sales were up 3.4%. Actually, if we look at December, it was down minus 3.3%. So it can be quite volatile. But what's pleasing to say is that January consumers have been spending, benefiting from January sales, which should be supportive when we think about economic growth in the UK looking out over the first quarter.
And that is probably part and parcel of what we like to think about as more of that forward-looking indicators versus those that are backward-looking. And we had that backward report, if you will, on what happened in the fourth quarter in terms of economic activity for the UK this week as well. And that was somewhat disappointing, although within it, once you dig into it, there are factors that are probably supportive of a slightly better and improving environment to the future.
Yeah, and I think the press, the newspapers will grab on to the headlines: UK economy in recession. We saw fourth quarter GDP at minus 0.3%. But when we look at those more near-term growth indicators, such as retail sales, it gives you a very different picture and a different perspective, and perhaps more important perspective because it's more timely, more forward-looking, rather than looking backwards.
And that's maybe the challenge for ourselves and for the market at the moment, that there is a number of these sort of conflicting signals that when we look at economies in terms of the employment side of things, or the surprising strength in retail sales might be a one-off in the UK. The contrast there with the US as well, their retail activity wasn't as good.
Exactly, you've got a real contrast between what's happening in the UK and the US with the data that's coming out. So the US economy has been really strong, really supported by consumer spending over the last couple of years. We get the retail sales data yesterday, actually disappointed quite a bit. It was actually negative, I think 0.6%, worse than expected. So it is a challenge for policymakers, for the Federal Reserve in setting interest rates when you've got some volatile economic data, and it's understandable that they actually are a bit hesitant to guide to cutting interest rates earlier because it's very uncertain.
And maybe then to also go maybe away from what we've been discussing in terms of the US and the UK, going out to Asia, Japan, we had Japanese GDP data this week, but we've also been able to comment on and see the strength of the Japanese equity market as well. So it might come as a surprise when we think about the GDP numbers.
Exactly. So with the fourth quarter GDP numbers for Japan was a negative, minus 0.1%. So very little negative growth. And that's really weakness in the domestic market, in the services sector in particular. But when we look at the Japanese equity market, it's been doing exceptionally well. Thinking just on a week alone is up 4%. And this has been one of our highest conviction views within the portfolio. So that's pleasing from our perspective and our clients. But it just shows you the dangers of trying to think about an economy and an equity market and trying to think, well, they must have a strong correlation.
And the nowhere better is that really illustrated than Japan at this point in time.
Absolutely.
And I suppose the other thing in Japan, we've discussed this in the past, is just the very different trajectory that it's on from a monetary policy perspective. We were talking earlier about potential for interest rate reductions. The discussion in Japan has been more about interest rate increases. Would it be fair to say with some of that data that thesis is maybe challenged a little bit? Or
I think so. There has been speculation, optimism that Japan will be able to get away from their negative interest rates, so very, very different to what we have here in the UK and in the US, because they've been getting stronger wage growth coming through, should be supportive for consumption. But when we look at the data, it's disappointing, and it's going to be more challenging looking forward this year to whether the Bank of Japan can actually get away from that. Perhaps they've missed their chance.
Okay. No, thank you very much, Paul. That's been a very good way of bringing together some of those key points that we've been discussing as an investment team this week. I hope you found that useful and insightful around those key areas. Please do join us next week as we look through morning markets and then also for our week in review.